Thanks for tuning in to Thanks for tuning into Talking Point. I'm your host Neeraj Shah. Let's take stock of our guest today, get him on the show, and try and understand what his views are. Jinesh Gopani, head of equities at Axis Asset Management Company, is our guest today. Jinesh, thank you so much for taking the time out. Pleasure having you.
Pleasure. It's my pleasure.
Thank you, Jinesh. How do you guys look at risk assets currently from your prism? Because at these levels or at all-time highs, we are seldom accompanied by decent valuations. So valuations naturally will be high. Is this conducive for additional risk taking, or do the valuations worry you?
Yeah, I think if you take the broad construct of the economy, the India's macro looks pretty positive. I would say from current account deficit to oil prices to interest rates, hopefully now pausing, inflation coming down, all key macro indicators looks pretty decent to positive. I would say the government heavy lifting in terms of capex continues the economy on roll. We are expecting around 6% kind of real GDP growth with inflation coming off from the high base. I think a general broad construct is good. Economy is looking decent in this global, which is a pretty recessionary world in that sense, where US, China, and Europe all are slowing down. So I think to that extent, India remains sort of an oasis in this ocean, and that is why you are seeing a lot of FII flows which went away during COVID is coming back. So I think emerging market ex China, then India becomes a relatively an important place to be in, especially when you are having a 6% kind of real GDP growth story continuing. So broad construct is good. You are right. Valuations become on the goes on the higher side when there is a lot of money trying to chase good quality companies, good growth companies. The only way to just ensure is to have patience and just ride through this wave. If the execution of the company is good and they are beating the estimates, then I think there is no worry. You can live with that higher valuation thing. But let's say a company is not able to execute and there is a high valuation, then obviously you are seeing stocks getting punished very severely. So I think markets are trying to give a thumbs up to companies who have started executing on ground, especially with strong balance sheets. I think one big thing which has happened, Neeraj, is after COVID, the focus on cash flow growth has gone up significantly for large part of the quality companies, and that is where I think the valuations are having a premiumization kind of a thing. So I think broad construct is good. We are not that worried. Obviously, we have to keep our eyes and ears open. We have to see how US trends. Is it a soft recession? Is it a hard landing? How Europe recovers? How China slows down or doesn't slow down? So these are all sort of events which you have to keep in mind. But general broad construct looks pretty good.
Yeah, too many variables. But the jobs data by ADP yesterday, or if indeed the belief around the non-farm payrolls today comes out, we're not gonna see rate cuts in a hurry. If anything, we'll probably see elevated rates for the foreseeable future. Do equities still become a preferred asset class? And if so, within that, do a particular sect of equities do better, value versus growth, or maybe some of the tech companies which have had a fabulous rundown? Do they kind of start unraveling NBFCs versus banks in India? How do you piece your head around all of this?
See, I think to answer it in a very simplistic way is basically execution on ground has to be impeccable. I think if you really see, even despite the strong job data coming, you did not see markets collapsing in US, right? It was like, let's say, last 2 days. If you really see, it has not been that major corrections which we are looking at. And also, to our surprise as well, despite the US Treasury yields going up and the job data being strong, the other data points like if I just talk around energy prices, like generally you would see natural gas prices going up if we expect that US is strong. So it is bit of a dichotomy that how it will really shape up. So you'll have to wait for CPI data. We'll have to wait for some other data to come by. Just one or two data might not give you a right picture about what's happening in US. Because as we see when we talk to companies and when we ask them about the export growth to US, I think clearly everyone is sounding caution, be it a service industry or be it a manufacturing industry. So we'll have to really see how data are moving over next 2 3 months, and then take a better view about how things will shape up.
That's an important point. All right. Therefore, if we take into account the Indian construct, I heard you in your opening answer talk about how India looks like an oasis in a growth stout world. But within that, if indeed companies exporting to US or Europe might not have the kind of market that they usually have, would it be better, Jinesh, to stick to larger parts of your portfolio being in domestic centric, domestic exposed sectors?
Yeah, certainly. I think that is how we have tried to construct the portfolio, and and generally India offers a larger growth opportunities if you are in the right sector and if you are in the right company. However, there are parts of global stories which you would not want to, I would say, miss out, and it is a very stock specific kind of an environment for the global investment. So you will have one or two companies in engineering, you will have one or two companies in IT, in pharma, or maybe in specialty chemical, which still might continue to do very well despite US moving into soft recession. Unless US goes into hard recession, I think you should have a mix of both. But you are right. Let's say 75 80% of the portfolio can be sort of a domestic portfolio, and then to hedge around if anything goes wrong on the domestic side, you need to have something to hedge around from the global investment perspective.
Yeah, so you guys have been proponents of quality banks. There is on a relative basis, not as much of a price movement relative to maybe even the earnings growth in some of these. Is it their time now to look at banks, or would you reckon that because of your thesis around how maybe the US, the data points are suggesting that some point of time recessionary winds come in, and therefore if rates go down and if India rates go down, then our NBFC is better placed. I'm just trying to understand how you're thinking about the most heaviest sector within the Indian landscape currently.
No, I think at this point of time, if the thesis is like India goes for a pause kind of a thing, and maybe after 2 3 quarters nearing to election, if there is some one rate cut which can come if inflation really is benign, I think then NBFC looks pretty better bet for next at least 12-month kind of a period, because the higher interest rate environment had hurt them in terms of both growth as well as higher cost of funds. And now that if the thesis is that there is a pause, inflation coming down, and the expectation of rate cut after 12 months or something around election, I think the growth momentum is really strong on that side. And as the cost of funds stabilizes, I think they would be in a better position to price their product well. Also, they are fixed rate loans, so generally in the falling rate environment, they tend to better, because liabilities will get repriced faster than the assets. However, I mean, as I said, it is still next 2 3 months are going to be crucial how really US moves in terms of yields, and whether US moves into soft recession or strong economy or hard recession, and that impact how RBI will take in terms of the differential of interest rates between US and India.
Got it. Dinesh, the last few data points around, and I mean over the last 3 or 4 months, data points around urban consumption is turning out to be pretty strong. We saw what hotels did in quarter four. The Titan update overnight seems to be showing some fairly strong gains, though I guess jewelry is probably across the country. But because it's Titan, I'm kind of adding that urban layer to it. Flights are full, airports are full. Are you constructive on urban consumption, or is it time to probably look at staples as well because the margin benefits might start coming in?
So, if your monsoons are decent, wage inflation is good, general inflation is coming off, I think then the propensity to consume generally goes up. Your confidence level goes up. So the rural, which was not doing well after initial bouts of COVID splurge, which happened where government did a lot of focus around rural in 2020. I think last 1.5 years, rural has not bounced back. So you are right. I think you should have a mix of both discretionary and staples because as generally we have seen that as inflationary environment cools off, the propensity to consume, the confidence level goes up, and with good monsoon, I think that will happen.
Got it. Jinesh, across the curve, and now especially even in the smaller construction names, we're starting to see some fairly marquee investors put in their bets. Now, these may be small bets relative to the portfolio, but people are taking bets, and it's not just restricted to the Larsen and Toubro or some of the other names. It's happening right down the curve. Um, what's happening here? Are you guys constructive on construction as a pocket, and therefore, are you also playing the whole curve, or are you sticking to the high quality even if it comes at a higher valuation?
See, I think the best way to play long term is more to play capital good kind of stories. If you are placing bet on infrastructure to do well, or maybe manufacturing story related to infrastructure, that would be the better way to play. To some extent, we have seen construction companies doing well in a period of, let's say, 1 year or maybe 2-3 quarters, and then the risk is the entry barriers are low. One project, if wrongly bidded, can take the entire PNL off. So we are not that, I would say, constructive on that. I think the better way to play long term infrastructure stories, either capital goods or building materials, where you are more focused on product selling, brand selling, and you get your money, and the margin levels are also high. So yeah.
Starting valuations not a hindrance there?
See, it is an intern, so obviously you have to build up your portfolio over a period of time. So unfortunately, that is how India stacks up when there is demand, when flows are strong, people are ready to give any some premium to the current pricing because people are looking at 3-5 year kind of a story. If you are playing only for 1 year kind of a thing, then I think a valuation will be a bigger role, I would say, as compared to the business model. But generally, if you are, let's say, playing a 5 year kind of a story for India and you want to make your money in 3 years, you are okay paying slightly higher valuation than what maybe the average valuations would be. So it's okay, I think, in that sense, but can't help it.
Can't help it. Yeah, that's true. Dinesh, last couple of questions. Firstly, the recent themes, and one of them is the beeline that global corporations seem to be making to announce the setting up of shops in India. I mean, Apple notwithstanding, a clutch of other things have happened. Now, I heard stories about how, because of such factories, the CNC machining companies have gotten orders which are burning through the roof. We are hearing the same thing happening for chemicals for the Northeast Asian countries and economies of Korea and Japan, and what some of these EV battery related chemical makers could be doing as well. Is there something out here that has stood out for you, which you think could be a large long term money making opportunity?
Yeah, I think clearly one sector which we feel that where India has a good ecosystem, good talent pool in place, and where a lot of opportunities can really come by is specialty chemicals. I think clearly you have a good ecosystem in place. You have good engineers around. You have good companies also. who have executed for many years now. What we understand is the inquiry levels have gone up, especially during COVID when there was a huge supply chain disruption, which led to many of the end consumers not having product on time or had to just wait for months for China to open up. I think clearly one such sector which we see where India can really make its presence felt on a larger scale is specialty chemical. The other sectors, manufacturing, I think what we are seeing, there is no technological edge which is available to us. It is more about sort of an assembly kind of a shop, or let's say doing a low end job coming to India. So I think when we look for businesses, we want something which is unique, which is where there is some USP, and which is not replaceable by any other two companies coming and destroying your business model. So I think specialty chemical really looks as a sort of a, if you may call it, a China plus one kind of a story, or uh, Europe plus one kind of a story, where large part of ecosystem is already in place, and you just have to ensure that you are executing at a scale and at the levels of quality required by the end consumer.
Okay, so that's the standard answer. Jinesh, my final question, and that is pre-earnings. IT numbers start coming in next week. Most notes that I read spoke about how, while they gave estimates, they spoke about how they believe that quarter one could even be worse than what the estimates are or consensus estimates would be. Trying to understand how are you guys positioned around IT? If there is a corrective move post potentially a weak quarter, could that present some opportunities for the long-term investors, or do you believe that opportunity is some time away?
So I think clearly, Neeraj, if you look at Accenture quarter which came by, though they missed the guidance what they had given, I think the stock did not react to that extent. Which maybe if you can just think around and just see what can happen. And again, I don't know what will happen, but it looks like that if it is a soft landing in US, I think you will see two quarters or 3 quarters of slow growth or some pain in the for the IT sector, but then the long term story should be very very strong. So what we are doing is we are equal weight. We think there is sort of a bottoming out process which is happening, and if it's a soft landing, I think then there is a play for next 2 3 years. As and when you see the Microsofts of the world, or the Amazons of the world, or Googles of the world start talking positive about their cloud growth, and on that adding to this Chat GPT kind of a new business model which can further help in terms of the other IT companies to have a better play. I think once you hear them in next 1 or 2 quarters that the cloud revenues have started bottoming out and it is going to go up, I think we should see even Indian IT companies starting to go up. So I think we are not that negative. Maybe 1 quarter here and there or 2 quarters here and there, but it is not that the sector is just out and in dumps, unless US goes into hard landing.
God, point well taken. Jinesh, Gopani, it's been a while, but pleasure talking to you today. Thank you so much for being with us on Talking Point.
Thank you, Neeraj. It's my pleasure. Thank you.
All right. And viewers, thanks for tuning into this edition of the Talking Point.